my name is Madelyn Ledoux, and today I will be giving a presentation of ratio analysis on 3 companies for my Finance 381 semester project. This presentation will answer 3 questions. First, which of the 3 companies would I give a short-term loan to? Second, which of the 3 companies would I give a long-term loan to? And third, of which company would I want to purchase 51%? The 3 companies I will be looking at are ExxonMobil, an oil company, Walmart, a grocery supercenter chain, and Campbell's Soup, a soup company. In order to answer the first question, which company would I give a short-term loan to, I looked at 3 equations that measured liquidity for each one. The current ratio, which is your current assets over your current liabilities, and an ideal current ratio would be above 1 because this means that your company has enough assets to pay for its liabilities. The quick ratio is nearly the same as the current ratio, with the exception of its exclusion of inventory among the assets. Because the sale price of inventory might have to be lowered if it must be sold quickly to satisfy a debt, and because inventory can be damaged or spoiled, the quick ratio is a safer measure of short-term solvency. Last but not least is the cash ratio. Simply cash over current liabilities, which answers, do I have enough cash on hand to cover my debts? Looking at Campbell over the last 5 years, we see that in no case does Campbell have enough assets to pay off their liabilities. The best they can do is a 0.99 current ratio 5 years ago. They seem to have experienced a drop in the ratios in 2012 and have not yet fully recovered. ExxonMobil's numbers look somewhat better than Campbell's. While Campbell never hit 1, Exxon has a 1.01 current ratio in 2012. Exxon seems to have substantially lower quick and cash ratios in relation to their current ratio. This is probably because the majority of their assets is their oil inventory. Looking at Walmart, we see that, like Campbell, they never have enough current assets to pay their current liabilities. Walmart's ratios are somewhat higher than Campbell, but because none of them are above 1, Walmart could run into difficulty paying off a short-term loan. After looking at the information presented, I decided that if I had to give a short-term loan, it would be to only ExxonMobil, because based on the liquidity ratios, they seem to best be able to pay off their liabilities. Next, who would I give a long-term loan to? To safely answer this question, I will look at 2 long-term solvency ratios, the times interest earned ratio and the equity multiplier. The times interest earned ratio, which is EBIT over interest, is a measure of how well a company has its interest obligations covered. A times interest earned ratio that is greater than 1 is wanted. The equity multiplier, total assets over total equity, essentially tells us how much of a company is financed by debt rather than by equity. While some debt is good because you're using other people's money to make money, it can be dangerous to have too many of your assets funded by debt. Therefore, while we don't want the equity multiplier to be 0, we don't want it to be too high either. Looking at Exxon, we see that they have a very high times interest earned ratio, with what appears to be a spike in 2013. While a high times interest earned ratio could mean a company has undesirable lack of debt, Exxon's ratios, with the exception of 2013, seem to be relatively stable. Campbell has a solid times interest earned ratio. In the past 5 years, it hasn't dropped below 1. However, they have a much higher equity multiplier than Exxon, which can be dangerous. At its best, 83 cents of every dollar in asset is funded by debt. Walmart has an extremely consistent times interest earned ratio. Its equity multipliers also seem to be consistent, as well as being relatively low, with the lowest being 2.46 and the highest being 2.69. I have chosen to give a long-term loan to both Exxon and Walmart. Because Exxon's times interest earned remain high despite some inconsistency, and its equity multiplier remained low, and because Walmart's times interest earned remained consistently acceptable while its equity multiplier remained consistently lowish. Finally, which company would I want to buy 51% of? To answer this question, we will use the DuPont analysis. First, we will take a look at the return on equity of each company. This means for every dollar of equity invested, how much profit is made. We see that Campbell's has the highest return on equity ratios. We notice that from 2010 to 2013, the ROE was dropping, but it picked up again in 2014. We will look more deeply into that on the next slide. Exxon and Walmart both have acceptable return on equity ratios as well. So, In order to answer the required question, we must delve more deeply into the DuPont analysis using return on asset and our old friend, the equity multiplier. Return on equity equals return on assets multiplied by the equity multiplier. Return on assets will tell us how much profit each company is making from every dollar of assets, and the equity multiplier will tell us how much of the company's assets are funded by debt. Looking at the ROA of each of the companies, we see that Exxon has a fairly high return on assets and relatively low equity multipliers. Walmart also has decent ROAs and decently low EMs. Campbell's has the highest ROA of any company in 2010, but we also see that it has the highest equity multiplier. To get a clearer picture, I have calculated the percentage of ROE that is made up of the equity multiplier for each company. We are looking for low percentages because this would indicate the percentage of ROE made up of return on assets is high, and that tells us that much of ROE comes from profit you've made off assets. Exxon has the lowest overall percentages, Walmart has the overall highest, and Campbell's are also relatively low, except for the 2013. Things still seem a little hazy when it comes to choosing a company to invest in, so we will further break down our equation and see what our ROA is comprised of. Total asset turnover, which measures asset efficiency, and profit margin, net income over sales, which measures operating efficiency and tells us how much of every dollar of sales a company actually keeps in earnings. Looking at these ratios for all three companies, we see that Exxon and Campbell have similar total asset turnover ratios, while Walmart's are almost twice as high. Campbell has the highest average profit margin, and Walmart has the lowest. Furthermore, we should look at the price-to-earnings ratio, which is the price of a share of stock divided by the earnings per share. This ratio will tell us how many times over the earnings go into the stock price. It is a measure of growth. Generally, a high PE ratio means that the company is expecting growth. The price per share is a measure of the future, and the earnings per share is a measure of the past. Looking at all three, they seem to be relatively in the same zone. Walmart has a nice consistent increase, which I like. Both Exxon and Campbell's fluctuate but remain good. Based on all this information, I would choose to purchase 51% of Campbell's, using the following reasoning process. First, I notice Campbell's has the highest return on equity, and upon breaking that return on equity down to find out what percent of the return on equity is financed by debt, I see that of the three companies, Walmart has the highest percent of return on equity being financed by debt. Exxon's average over the last 5 years was 9%, and Campbell's was 10%. They were very close. In the most recent year, Campbell's decreased their percentage to their average, and Exxon increased their percentage to 1.7 above their average. At this point, I eliminated Walmart from the running and was leaning towards Campbell. Looking at total asset turnover and profit margin, I see that Campbell's is a slightly more efficient with their assets, and in addition, they have a decent price-to-earnings ratio. This is why I would choose Campbell's. Thank you.